Good afternoon, I'm Brigid and this is Currency Wars. Let's have a quick look at the notable highlights from the past week. Predominantly, the OPEC decision not to cut the oil production saw oil prices plunge further and other commodity prices also tumbled, with gold suffering from the Swiss referendum seen to reject the proposals to boost that central bank's gold reserves. Meanwhile, macro data out of the Eurozone and the US continue to paint a picture of economic divergence. That is, the November Eurozone manufacturing PMI came in at 50.1, the lowest since June last year, with German new orders subdued at 47.1. This contrasted quite severely against the better-than-expected US ISM manufacturing PMI, which printed at 58.7, and the non-manufacturing component at 59.3. This was supported by strong new orders and the production components. Equally, China and the UK have produced disappointing growth metrics, with China recording another soft manufacturing PMI and the UK experiencing its deepest contraction in M4 monetary supply growth since the late 2012s. Locally, however, South Africa's trade account deficits surprised with a huge 21.3 billion deficit. This, as exports versus import growth of 5.6% versus 17%, is a cause for concern. South Africa clearly cannot afford to fund its imports through exports or through capital inflows at present, leaving the rand as the correcting mechanism. Today, the focus will be on the ECB and the Bank of England's announcements. The ECB is expected to assess the impact of their current LTRO program before embarking on further quantitative easing in the first quarter of next year. Meanwhile, the Bank of England is expected to keep rates steady amidst the slower growth outlook in the United Kingdom. Right, now that we've seen the lay of the land, I'd like to welcome my guest hosts today, Andre Cilliers from Treasury One and Andre Eereenstein from RMB. Welcome. We're winding down the year, so we expected to see a rand a little bit weaker. Obviously, this divergence that we're seeing globally, let's talk about that first, because that's really the interesting phenomenon that we're seeing. We've got a couple of factors. So let's first focus on this oil production. That was quite an interesting decision by OPEC, and I think caught quite a lot of people off guard. And with oil trading now below that $70 a barrel, what is your expectation around the oil going forward?
That's a tricky one. I think when we look at it, it's going to remain weak going forward. I can see it going to probably 65, maybe $60 a barrel, but I can't see it going further. Yeah. And in the longer run, I still think that we're going to have oil prices that's going to drift up to 80, 90, but we're talking about 9 months away.
But then the interesting thing was, I mean, when we saw that announcement and we saw the oil price come off, a lot of clients of mine have asked around, why is it that we saw the dollar rally as hard as it did? And then we also saw equity prices come off. So can you give a little bit of clarity with regards to that, Andre?
Well, one of the other reasons it was not just OPEC that didn't make they didn't lower their production. It's also that out of the US itself, their production out of natural gas and so forth is a lot higher, with expensive technology, but that makes them less dependent on the OPEC countries. Okay. And I think that's one of the reasons why the dollar actually came out a little bit stronger out of this one.
Because it was quite surprising. You would have thought that the export of the oil out of the US would have been something that's attractive for, obviously, those that have invested in that industry stream. However, obviously, with regards to the OPEC decision, do you think that this is something that they're going to continue with regards to allowing the free flow of oil, or do you think that there will be a point of no return where they're going to have to step in and pull back something?
Well, that's going to be a level dependent thing. You know, if we see $50 a barrel, then I don't think they'll have much of a choice. But I think when you look at it, the dollar's going to remain strong, because also as the oil price comes down, it's a one-to-one benefit for the US economy. Yeah. They don't have any sort of exchange rate issues. It's a one-to-one benefit, and that goes straight into the consumer, and that's why the US economy tends to do quite well when the oil price comes off, particularly when they're also self-sufficient.
Well, that's the thing, and I think that that's another, if we look at this divergence with regards to the Eurozone, we look at China, we look at Japan, and then we look at the UK, all in the slump. So everybody that's on the eastern seaboard outside of the United States is all sitting in a scenario where the growth scenario really looks dire. I mean, we've got the ECB today, we've got the Bank of England. Unlikely, I think, in the ECB with regards to extending quantitative easing into this quarter, but certainly there is the opportunity for the first quarter next year. And what is your view on that?
Yeah, I think the ECB are very good at talking a good game, and I think they will find it very difficult not to act. I think probably first quarter next year, and then they will do. The mechanism through which they're going to be able to to do quantitative easing, in my mind, is quite complicated.
Yeah.
And at the end of the day, for me, QE is not about, it's not about a supply of money. It's a demand story. In the Eurozone, it doesn't matter how cheap the money gets. People are just not,
want to borrow.
People are not just going to borrow. You know, if they can't secure the employment, then they're not going to borrow.
But then it is also about protecting the sovereign debt. So it's, you know, just looking at how to protect those levels in terms of the sovereign debt. What do you think if they really do decide to embark on some form of quantitative easing, a little bit more aggressive than the LTRO program towards the first quarter of next year, what is your view in terms of the impact on the euro dollar?
I just have to go back to what Andre just said. It's a question of demand. You can make money as cheap as possible, as cheap as you want to. If there's no demand, then all that money will actually just flow out of the country, out of the Eurozone, into emerging markets where there's slightly better yields for them to attract, and the Eurozone will still be under pressure. So as far as the euro dollar is concerned, I'm a very negative person on that. I look towards the 120 levels and even possibly breaking that.
That's quite interesting, because then they'll be on par with the Swiss franc.
Yes.
So if we look at the Bank of England, unlikely to hike interest rates. We look at the Bank of Japan, embarking on quantitative easing. The ECB, probably going to embark on more aggressive quantitative easing. Does that equate to potentially more inflows into South Africa? And if we look at what happened with regards to the trade deficit, our own manufacturing data, and then obviously the impact of imports versus exports with the gold price having come off, what is your view in terms of South Africa as an opportunity for inflows with regards to that extra money that will be on book potentially next year?
Well, I think a rising tide will rise all ships. And I think if we're going to have more flows coming in, substantially more flows, then yes, I think emerging markets in general will benefit.
But in South Africa particularly?
My personal view is I think that our fundamentals don't support a substantial overweight. So if you look at an emerging market index, for example, South Africa wouldn't be overweight, because there's a lot more, you know, emerging markets that are offering a much higher yield. And their fundamentals aren't as bad as ours. So that's really where the SARB need to kind of step in, and then we need to then address the issue and say, you know, do we have to raise rates, not because we want to, but we want to stem the fact that, you know, protect the currency and protect those flows.
Well, that's the thing, and I think that that's maybe a question that we can ask ourselves for next year, because really there's two big questions. If interest rates, which they look likely to, I mean, step in if you disagree with me, but with regards to both the United States as well as obviously the weaker regions being Japan, the Eurozone, and obviously the UK, if that's the case, we've got this low interest rate environment, which we've basically had the entire scenario during 2014. So going into 2015, something that's been quite interesting is a lot of talk about management of imbalances, current accounts deficits. How are emerging markets managing that, especially as we start to go into this potential for some form of interest rate hikes out of the emerging markets? I mean, Brazil hiked rates yesterday. So what is your view with regards to how much pain will we feel from the fundamentals that we know exist in South Africa? What type of leeway do we have in terms of a timeline in terms of trying to get that right before we start to see the growth picking up again and interest rates being hiked out of the United States? So looking into the following year, let's just give our viewers just a basic idea in terms of your big picture thinking.
Well, if we look at fundamentals take a long time to react. If we're going to talk about current account imbalances and those things, they take time to correct. I think we don't have that much time. My view is that the Fed actually go probably sooner rather than later. They're going to be waiting for signs of wage pressures. Yeah. And I think with a very low unemployment rate in the US, you know, we've got non-farm payrolls tomorrow again. Yeah. But certainly there's a long trend of 200,000 plus. Yeah. And that's going to manifest into wage inflation. Yeah. And when that happens, and in my view it's probably going to be first or second quarter next year, the Fed will have to react. So we don't have a lot of time. You know, if we're talking 6 to 9 months, you know, even
to correct the imbalances that are present in the economy.
It's highly unlikely.
In your view, Andre?
February on our side, a very important one when the budget speech gets delivered, to see what happens, how we raise our income, how we curb our expenses, what our deficits are, and how that's predicted going forward. And then I think looking towards the first and second quarter and labour stability and production increases, changing the numbers. We've had the trade deficit coming out this month, which was an extraordinary high number, but I think there's a bit of an abnormality in that because I think the oil imports was a little bit higher. So I think that could flatten out a little bit over the next quarter or so. And I think that changes the trade balance figures a little bit. Budget, very important. Enough inflows out of the Eurozone on the short term to fund our deficits. But as I say, those two key ones, important to see what happens further into the year.
Thank you. Right, now that we know where we stand, the real risks and opportunities, we're going to pull out the big guns. So I want you to give the viewers a view in terms of the next couple of weeks, what we can expect before year end, specifically around the cross rates, the euro rand, the pound rand, and then obviously the dollar rand. So I'm going to start with you for a change, Andre.
Okay, on the euro rand, I think that, as I said, the euro dollar is still under pressure, and I think our ranges there, or my prediction would be towards the 13.55, 13.80 level. Pound rand towards the 17.25, 17.60 level. Dollar rand in the order of 11 to 11.25.
Okay, and you, any divergence on that?
No, on the cross rates, I agree with Andre. I think the theme is going to be a dollar story, and I think the crosses are going to remain relatively stable. If we look at dollar rand, I think the surprise risks going for at least for the rest of the year is that we actually have a weaker non-farm payroll number tomorrow, which is going to support the rand. So I think for the next coming weeks, I'm on a 95 to 15 level on dollar rand, and I think crosses will remain fairly stable.
Okay, that's fair enough. So basically, in conclusion for the week, we are looking at, Andre thinks on the euro rand, we're probably going to see a further strength, looking at around 13.55 on the bottom. Euro rand also further strength, looking at around 17.25. And then on the dollar rand, we've got a view of about 10.95 up to about 11.20. We can expect to see further importers, obviously, as we hit the Christmas season, but then there's the quiet around Christmas, New Year, where we normally see a little bit of a pullback. So those ranges remaining intact for the remainder of this year. Until next week, you are more than welcome to text me. You can text me on my Twitter at Brigid R. Taylor or hashtag CurrencyWars410 for your personal comments to the FX markets. Until next week, good luck in the trenches.